In the previous sessions, we studied about the variance analysis, what variance actually is, and how variance is analyzed between the different cost of production, that is in terms of material, labor, and overhead. Now today we will do a comprehensive example for the variance analysis, and will calculate all the above variances which we discussed earlier. In examples, company usually first of all make a standard cost card, that is the budget or standard. First standard is established, then actual production, actual purchases is carried out, and then variances are computed, calculated, and analyzed. So let's suppose this is a standard cost card of any manufacturing company in which they establish that materials will be used for producing a single unit will be 5 kgs, and 1 kg required will be at $2 per kg. So it will make a total of $10 per unit. Then obviously labor have to work to produce the units. So let's suppose they have established that labor will require 3 hours to produce a single unit, and daily wage rate or hourly wage rate would be $5 per hour. So it would be $15 per unit. And then variable and fixed FOHs, factory overheads will be incurred. So variable FOH and fixed FOH will be estimated. As far as variable FOH is concerned, it will be again 3R direct labor. They are applied on the direct labor basis at $3 per hour. So it will make $9 per unit. It means producing 1 unit, $9 per unit of variable factory overhead will be incurred. Likewise, fixed overhead, if we talk about the fixed overhead, it will be again 3R at $2 per hour. It means to produce a single unit, $6 per unit of fixed FOH will be incurred. Now, in this way, the company has established a standard cost of materials, labor, and overhead, and combined separately, that is variable overhead and fixed overhead. So, in total, the total cost of production will be incurred will be the total of this will form $40 per. Now, if we see the manufacturer's perspective, they will obviously incur cost and then add a profit margin, profit ratio, profit rate, and then they will sell at a certain selling price. So a profit margin profit ratio will be added, that is $10 per unit. So the total selling price will be worked out as 40 plus 10, that is 50 per unit. It will be sold in the market. Now they have established how many units can be produced in a month or in a week. That is the budgeted or standard production, budgeted production. Estimated production, ideal scenario production. They establish that ideally they can produce 50,000 units in a given week or in a given month or in a given period. This is the budgeted production. Now these are the budgeted or standard data. Now the process will begin, and eventually the final figures of material, labor, and overhead will come out. Then we will have the actual data. Now, actual data works out to be the production and sales. All those units which we have produced have been sold. That is production and sales. We have produced 48,000 units as against the budget of 50,000 units. So in this case, apparently we can now analyze that we are beyond that standard of budgeted production, or there might be less efficiency. But now we will compare this production with the standard data with respect to that production, not that production. We will see how it will work. Obviously, okay, production and sales are 48,000 units at rupees 51.5 per unit, at dollar 51.5 per unit. Now these is the production and sales. Means we have sold 48,000 units at the rate of 51.5 per unit. So if we see right now, the selling price we established as 50 per unit, but actually we are selling it at 51.5 per unit, then there is a clear understanding that it seems to be a bit favorable because of the higher selling price. Now again we have obviously purchased materials. So material purchased and used. Is equals to 245,000 kgs. Obviously the material is purchased in terms of kgs. So it would be 245,000 kgs at the rate 2.05, at the rate dollar 2.05 per kg. This is the actual data. Then obviously we will pay to the labor the wages. So wages paid. Wages paid are worked to be 145,000 hours. That is, the labor has worked a total of 145,000 hours, and they have been paid at the rate of $4.95 per hour. And we had established that they will be paid $5 per hour. So apparently we will see that there is a favorable circumstances of the labor rate wages. Well, now FOH incurred, that is fixed and variable. So variable FOH incurred works out to be $440,000, and fixed FOH incurred works out to be $297,500. Now what we have to do? Obviously we have to calculate that all respective material, labor, that is the material, labor and FOH variances. So we will start one by one by referring to the data. That is, we will calculate first of all material price variance. Material price variance. Now the formula need not to be memorized. Exactly what we have to do, that is we have to see whether which variance it pertains. If it is material price variance, then we will obviously compare the data of actual and budgeted or standard price of the materials. Now, before doing or calculating the variances, it is my sincere advice to just work on the two things so that the variance calculations can be made easy. Two calculations, that is, number one should be the standard quantity allowed, the allowance of standard quantity with respect to the actual production, and standard hours allowed. How they will be calculated? Look at here. See, we have what budgeted production of 50,000 units, but we are not at the mark, up to the mark. Just we had produced 48,000 units. But this does not mean that we are lacking behind. Obviously, there are some unavoidable circumstances. So we will prorate the standard data with respect to the 48,000 units. Now what happens? See, if we say that for producing one unit, we will require 5 kgs. This is the standard. So if we had produced 50,000 units, so we would have required 50,000 into 5. That is 250,000 units, 250,000 kgs. But actually we have produced 48,000 units. So how much on a standard, according to this 5 kg, how much we should have used? That is 48,000 into 5. That is 240,000. Now our standard, according to the production, actual production has been dropped from 250 to 240,000 kgs. This is what our actual standard quantity allowed with respect to the actual production. Standard quantity allowed or standard hours allowed when we see with respect to the standard production, actual production. Sorry. Hope this point is clear. Now, if we see that we have calculated the standard quantity allowed, that is 48,000 multiplied by 5, that is 240,000 kgs. Similarly, if we see that for producing 48,000 units, we have allowed 3 hours. 50,000 units, we have allowed the 3 hour per unit. So producing 50,000 units will require 150,000 hours on a standard. But since we have produced just 48,000 units, so we will prorate it on the basis of that standard, and 48,000 into 3 will be worked as 144,000 hours. So in this case, our standard hours allowed would be 144,000 and our standard quantity allowed would be 240,000. So we will write standard hours allowed as 144,000 hours. Clear? Now we will easily calculate. We can easily calculate the material price, material quantity, labor rate, labor efficiency, and variable overhead variances. So now material price variance, no need to memorize the formula, just keep the concept. Material price variance will be what? Material price variance will be the difference of actual price and the standard price, and multiply by, obviously, price would be what? Actual quantity purchased. So material purchase is 245,000 kgs. So it would be multiplied by 245,000. Actual quantity purchased. So simply if we calculate it, actual price is for material 2.05 per kg and standard is 2. So obviously 2.05 actual minus 2, although there is a slight difference between the prices, but the moment we saw the actual price is greater than the selling price, we have established that this variance is going to be, yes, adverse. So the material price variance would be adverse, and how much adverse? Into actual quantity purchased, that is 245,000. So the material price variance would be worked out as 2.05 minus 2 into 245,000. You can check it. You can personally do it. So it would be $12,250. adverse. Just write A would be sufficient. So this was the material price variance. Now we will calculate material quantity variance. Its symbol is MQV. It is obviously the difference of the standard quantity allowed and the actual quantity used. So we will write as actual quantity used minus standard quantity allowed. And when there is a quantity, it will be multiplied by the standard price. So actual quantity used is also 245,000. So we will write 245,000. Standard quantity allowed was 240,000 for that units. Production of 48,000 units. Now see what happened. For producing 48,000 units, on the basis of standard, we were allowed only to consume 240,000 kgs. But ultimately we consume what? 245,000 kgs. So it would appear against as an adverse material quantity variance. By seeing the actual and standard quantity or actual or standard price, we immediately establish that these variances are adverse or favorable. Now what? We have to just multiply it by the standard price, and the standard price will be taken from here. Also, it is 2. So the material quantity variance will be worked out as 245,000 minus 240,000, 5,000 into 2 is $10,000 adverse. That now the combined material price variance and the material quantity variance will be referred as material cost variance. That is MCV. Material cost variance is equals to material price variance plus material quantity variance. Since both are adverse, so they will both be added, like just like debit, debit, credit, credit. So 12 is 250 plus 10,000. So overall material cost variance would be adverse, and it would be worked out to be $22,250. That is also adverse. So in this way, material price variance and material quantity variance are calculated, and they are combined into material cost variance, or we may say it on a reverse basis, that is material cost variance is split into material price variance and material quantity variance. So that was about the material variances. Now we will look at the labor variances and the labor rate variance. Labor rate variance, obviously the difference of rates, that is actual rate, how much he has been paid, and the standard rate what we established into actual hours worked. Actual rate was paid at 4.95 and the standard was 5. So 4.95 minus 5 into actual hours worked, 145,000. Now see, here we can easily establish that since the actual rate is lesser than the standard rate that we have established, and it is a rate variance, it is favorable for the company. We will see for the company perspective, not the labor perspective. So it is favorable for the company, and therefore we can establish that this is going to be a favorable variance, and hence labor rate variance will be worked out to be, that is $7250. Favorable. Now we will compute the labor efficiency variance. Efficiency refers to the number of hours worked and as compared to the standard hours that were allowed. So efficiency would be the difference of actual hours minus standard hours allowed multiply by obviously that will be the standard rate. So actual hours worked were basically 145,000 and the standard hours allowed were 144,000. Now apparently although there is a little bit difference, but obviously it would be adverse from the company's perspective because labor has taken 1,000 hours extra to complete the task. So it would be adverse. Multiply by standard rate is 5. So labor efficiency variance will be worked out to be $5,000 adverse. Now the combination of the labor rate and labor efficiency variance would result in the labor cost variance. So labor cost variance is equals to labor rate variance plus labor efficiency variance. Now here the concept of plus minus will not work. Basically, the combined, see, one is favorable and one is adverse. So favorable and adverse will be minus, and the sign pertains to do that variance which is a greater value. So favorable has a greater value. So ultimate labor cost variance would be favorable. So we will write it as labor cost variance is equals to 7250 minus 5,000, and that is 2250 dollar. Ultimately it will be favorable. So we don't have to put into the ourselves in the tension of whether minus or plus. It is just a logical thing. Favorable and adverse would combinedly negate the effect, and the amount which has a greater value will prevail. Now these were the labor or rate variances. Sorry, labor variances, that is rate and efficiency variance, and combinedly they will be from the labor cost variance. Now there is a turn of the overhead variances. First, we will do variable FH variances that we had done in the formula. This formula will be applied here. See how it will be applied. Variable FOH spending variance. Actual variable FOH incurred. Actual FOH incurred. That would be in the data FOH actual was dollars for 40,000. Similarly, the next would be budget based on actual hours worked. Actual hours worked. Now, as we had seen earlier, we had learned that budget or standard can be used interchangeably. So now how it will be calculated, that is very important. Budget based on actual hours worked. How many actual hours worked were? Actual hours were basically 145,000. So we will write actual hours 145,000. Multiply the budget or standard of the variable overhead. Budget or standard of the variable overhead is $3 per hour. So we will write $3 multiplied by $3. So this will be worked as an amount of 145,000 into 3 would be $435,000. So now the difference, so 40 minus 435,000 would be obviously 5,000. Now see whether it would be adverse or favorable. Budget is 435. Actual is 440 means actual is exceeding the budget. That is not good. So it would be adverse. Now the second one is that we did yesterday. That was variable FOH efficiency variance. Efficiency variance again. Budget based on actual hours work. This amount 435,000 will be again written here. I am directly writing it. Now the next would be what? Next word standard variable FOH. Standard variable FOH. It's all about standard. It will be worked as standard hours multiplied by standard rate. That is standard hours into standard rate, standard hours allowed, and standard hours allowed were worked to be 144,000. So it would be 144,000 into standard rate, that is $3. So it would be the amount of 432,000, and the resultant amount would be 3,000. Now see how it will be worked, whether it is the adverse or favorable. It would be compared between these two. Now this is basically based on what? Actual hours worked. This is actual hours worked. So here the sense is for actual, and in this case it is the sense is for standard because standard hours and standard rate. So it is all about standard. Now we will consider the standard. If standard is lesser, then it will be favorable, and if standard, sorry, adverse, and standard is higher than actual, then it would be favorable. So standard was established to be 432,000, but actually it was 435,000. Means we are exceeding standard, and that is not good for the company. So again, this variance would be again adverse variance. So this is the concept how we see the adverse or favorable in this case. Hopefully, at this level, you are getting these things. Now we will move towards the fixed overhead variances. Expenditure, budget, spending. Actual fixed FOH. Actual was work to be 297,500. Yes. Dollar 297,500. Now fixed FOH budget. How it will be worked. We had budgeted production of 50,000 units. That is budget. And for the budgeted production, we had earlier discussed that fixed overhead remains same at all levels. But here, fixed FOH were incurred to 97,500. But for 50,000, it was established that fixed FOH was to be established or was to be applied at $6 per unit. So for one unit, it would be $6, not per hour. I am talking about, do not confuse here. This is very important discussion. I am saying that for producing one unit, fixed FOH will be incurred by the $6 per unit. So for budgeted production of 50,000 units, fixed FOH will be incurred multiplied by 6. That is $300,000 units. So this would be the budgeted fixed FOH, and it will be written here fixed FOH budget, that is $300,000. How it will be worked? It will be worked as budgeted units multiplied by total fixed FOH rate per unit. That is 50,000 multiplied by 6. Okay, now difference is 297,500 minus 3,000 is 2,500. No need to show the minus sign. It is just the calculation of the difference, and now we will see whether it is favorable or adverse. Now the budget is 300,000. The actual was incurred 297,500. Obviously, the actual is lesser. Therefore, it is a favorable situation in the case of fixed FOH expenditure or budget expenditure. The next is fixed FOH volume variance. How it would be calculated? It would be calculated fixed FOH budget. This amount will always, like this efficiency variance will come here, that is $300,000. And the next would be standard fixed FOH. Standard fixed FOH, like standard variable FOH, that is standard hours into the standard rate of fixed FOH. Standard hours is 144,000, and obviously we have to multiply rate of standard hours, so we will multiply it per hour, not per unit. It is the matching concept. For unit, per unit will be multiplied. For per hour, for hours, total hours or actual hours or standard hours, per hour rate will be multiplied. So fixed per hour, 2 per hour is given. So we will write here 144,000 into 2, and the amount would be 288,000. So the difference would be $12,000. Now see if it is favorable or adverse. In this case, this is fixed FOH budget, fixed for all levels, 300,000. And the standard that was given for a particular production of 48,000 units or particular production of works for the 144,000 units was 288,000. So standard like this actual, and compare this with this. So standard is lesser, and the fixed FOH budget was applied to be greater. Therefore, it will be worked as adverse variance of the fixed FOH volume variance. Now, as we had discussed that this volume variance can be classified or bifurcated into splitted into two more. That is the capacity variance and efficiency variance. So we will look at that how they are splitted into capacity and efficiency variance. Fixed FOH budget. Fixed FOH budget we had calculated 300,000. There will be capacity variance and we will compare it fixed FOH budget if fixed FOH based on actual hours. Actual hours 145,000. We can see in the data. Actual hours 145,000 and fixed overhead rate 2 per hour. So 145,000 multiplied by 2, it would be 290,000. So the difference of this two would be the capacity variance and it would be 10,000 adverse. Done. Now in this between there will be efficiency variance. Efficiency variance and will be compared between fixed FOH based on actual hours and fixed FOH standard charge to production, that is standard hours into standard rate 288,000. So I will write as fixed FOH standard charged to production. You may get some MCQs like that. Please calculate or subparts. Calculate fixed FOH standard charge to production. So you should know how to calculate it. That is standard hours allowed into standard rate. That is work. That is work to be $288,000, and the difference of this one and this one would be the efficiency variance, and it would be 2,000 adverse. So the total 10,000 and 2,000 combinedly will make as 12,000, and adverse are added, so it would be adverse, and this would be tallied against this 12,000 adverse. It means we have calculated that fixed FOH volume variance and capacity and efficiency variance correctly. This is a sort of test. So see how these things work in case of variances. Now we have still this question outstanding. We have to do some sales variances, some income statement actual and profit reconciliation that we will do later. But for the time being, my advice is that attend this lecture carefully first of all. Then again, take a screenshot of this question and attempt this question at your own. This will take a time, but obviously it will strengthen your concepts, it will strengthen your formula, it will strengthen your working. If this is the master question, if you grab it, then all other questions pertaining to the variance analysis will be easy. For the sales variances and the profit reconciliation, I will share the lecture later. But for the time being, you have to attempt this lecture, attend this lecture carefully, and then attempt the question at your own. So this would take time of the lectures time and also the lost classes as well. Then we will move forward. Thank you.